let's talk about stocks. Stocks represent shares of ownership in a corporation. When you buy a stock, you participate in the company's assets and earnings. Since stocks can lose money, why should you continue investing in them? Well, compared with other types of investments, stocks overall have had a strong performance record over the long period of time, providing an 11.5% average annual return over the last 40 years. Although stocks tend to be volatile, investors have been able to lower their exposure to the market risk on a historical basis by investing over the long term. For example, based on historical performance of the stock market, over the past 40 years, the chance of losing money in stocks over a 1-year time period was 17.5%. After 5 years, the odds of experiencing a loss declined to 13.9%. And after 10 years, the chance of loss fell to 6.5%. Remember that past performance is not a guarantee of future results. Now remember, investors who keep investment fundamentals in mind may be able to build portfolios that help them smooth out the market normal ups and downs. The price-earning ratio is a simple mathematical calculation which you divide the price per share of a stock by the company's annual earnings per share. The result tells you the price you're paying for each dollar in earnings for that stock. For example, assume you own a hypothetical stock that costs $20 per share, and the underlying company has annual earning of $2 per share. In this case, the stock price per share, $20 divided by the annual earnings per share, $2 equals 10. And therefore, the stock has a PE ratio of 10. You pay $10 in a share price for every $1 annual earning. A high PE ratio is generally considered to reflect market optimism about a company's future, but it shouldn't be taken literally as a basis for an investment. Different sectors of the economy often reflect significantly different PE ratios. Of course, value isn't the only consideration when examining stock investments. You might also estimate how volatile the stock is likely to be using its beta. The beta is usually expressed in a number such as 1, 1.25, or 0.85. This number is a statistical measure of the relationship between a stock expected return and expected return of a broad stock market index, such as the S&P 500 and the Dow Jones Industrial Average. The beta is a correlation with the movement of the market as a whole. So when calculating a stock beta, analysts use a formula that sets 1 as the base for the market. And if a stock beta is 1, the stock will tend to move with the market. When the market rises 10%, the stock can be expected to rise 10%. That's on average. If a stock beta is 1.5, it'll typically tend to be more volatile than the market. So for example, the market drops to 10%, the stock can be expected to drop 15%. So a common misconception is that bonds are appropriate only for conservative investors. However, because bonds are generally less volatile than stocks, they can play a stabilizing role in almost any portfolio. So treasury bonds are long debt obligations of the US government with maturities ranging from 10 to 30 years. The interest earned on these bonds is exempt from state and local taxes, and treasury bonds are guaranteed by the US government as to be timely payment of principal and interest. You look at municipal bonds, they're debt obligations issued by the state, county, parish, or local government, or by some other municipal authority, like a public-owned water district, for example. So municipal bonds are typically issued to obtain funds to build and repair public works projects. The interest on municipal bonds is generally exempt from federal income tax. If you purchase municipal bonds of a state or a city in which you live in, the interest may be actually exempt from state or local income taxes. And some municipal bond interest could be subject to the federal alternative minimum tax. And if you sell a municipal bond for a profit, you could incur a capital gains tax. Now let's go to corporate bonds. They're much more a source of corporate borrowing. Debentures or unsecured bonds are backed by the general credit of the corporation. Asset-backed or secured bonds are backed by specific corporate assets such as property or equipment. And these bonds generally have a higher yield than government bonds, but the income they produce is fully taxable. Until you become familiar with bonds, bond investing actually can be tricky. So let's go over some of the nuances in greater detail. Most bonds are sold at par or face value, which is the price which the bond is issued, and they pay interest to the bondholder on a regular basis. When a bond matures, the borrower repays the bondholder principal in full. However, you can sell a bond on an open market before it comes due because bonds' value will rise or fall in response to changes in interest rates. If you sell your bond before it reaches maturity, you may end up receiving more or less of the original face value of the bond, depending on interest rates at the time. So when interest rates rise, the market value of the existing bond falls. And here's why. Let's assume you want a bond investment to earn $1,000 over the next 12 months. If bonds are currently paying 6%, you would need to invest $16,666 to earn that amount. If bonds are paying 8%, you would need to invest only $12,500 to earn the same amount. That's pretty straightforward, right? So consider this thought. Let's assume you invested $16,666 in bonds paying 6%, and the prevalent interest rate then rose to 8%. If you were to sell your bond portfolio before your bond mature, how much would you get? That's right, $12,500. Do you see the problem? One way to address fluctuating interest rates is to stagger the maturity dates of the bonds in your portfolio. This strategy is called bond ladder, and it may help limit exposure to low interest rates while also increasing the likelihood that at least some of the principal may be available to reinvest when rates are rising. So you can create a bond ladder over a period of time by purchasing bonds of the same maturity every year or two. Alternatively, you could create a ladder during the same time period by purchasing new issue bonds of different maturities, or by purchasing bonds on the secondary market that are scheduled to mature in different years. For the latter strategy, you might purchase a 10-year bond scheduled to mature in 2022, 2024, 2026, 2028, and 2030. Of the major investment categories, cash alternative tend to be the safest, which means that there's little fluctuation in their value. However, if you're locked into low-yielding cash alternatives such as a saving account, a CD, or a money market fund, you'll be subject to interest rate fluctuations, and your investment may not outpace inflation. And that's a key point. So savings accounts usually offer a higher level of security, but relatively low rate of return. They don't require large initial investment, and the funds in them are readily accessible. For many people, their main attraction is convenience and liquidity. Now, CDs are really just a short-term loan to a bank, credit union, or savings association. They typically offer a moderate rate of return and relative safety. CDs usually require larger initial investment than savings accounts, and you must leave your principal for a term in order to avoid early withdrawal penalties. Now, money market accounts funds invest in a diverse portfolio of a short-term financial vehicles. The main goal is preservation of principal accompanied by modest dividend. Money market funds are very liquid and considered to have low risk. But remember, they're not insured by the FDIC. Now, in a low interest environment, the value of low yielding investment may be eroded by taxes and inflation. So when determining how much of your portfolio to devote to cash alternatives or to any other type of investment, keep in mind that taxes and inflation can take a toll on your returns. Let's look at that example. If you invested $20,000 in an account earning a hypothetical 3% rate of return, it would earn $600 after 1 year. For someone in the 32% federal income tax bracket, this amount earned after taxes would be $408. So the after-tax value of the account would be $20,408. After a 3% hypothetical rate of inflation is applied to the balance, the real rate of return on the investment is negative 0.93%. In this case, your investment would actually have lost money. Of course, remember that this is an example and it's hypothetical and just used for illustrative purposes only.